Tax payments to a surviving spouse. It is brutal, my friends. So I'm going to share with you some of that here using a software that I use called Write Capital. I think you'll find it very interesting and illustrative, so you can see actually not just the spreadsheets I use, but actually on the software that's wonderful software. But the tax situation for a surviving spouse, it's bad. So welcome to Heritage Wealth Planning, my friends, the place you come to figure out how surviving spouses get hammered with taxes. I want to jump right into this. So I use this thing called Write Capital software, and you can see it up here, Write Capital. Now I'm using my man Dustin TIbbits' nest egg version of it, and Dustin is a Jazz Wealth Managers in Florida someplace, and Dustin TIbbits is a good guy. Jazz Wealth, I'm a big fan of what they do. And so he uses the chassis, if you will, is Write Capital. I think Dustin was able to get some different stuff put on there for his specific firm's platform, and that's what I'm using here. Pretty much all the similar platform, though, but I want to show you something. So this is interesting. So I have a hypothetical couple. It's just my wife and I, all right? So basically I threw some numbers in there, and I'll just show you the dashboard. I'm going to dive into this a lot deeper as we go forward. I just want to show you the tax thing, because I was just looking at this right now. And so I'm just saying Charlotte and Josh. Charlotte's 4 years younger than me, so she'll die. I'll die 4 years before she will. We have $351,000 investments, all IRAs, $500,000 in a home. We have a mortgage of $258,000, a net worth of roughly $600,000. I don't want to dive too much in that right now, just because I will in other videos. But I want to go to the tax stuff here, because the Write Capital tax stuff is just phenomenal. Stumbling over my words once again. I don't even drink. That's just being from Maine. Anyway, all right. So what I love about this, you can see this kind of chart here. They're visualizing it. So right now I'm 58. I think Charlotte's 54. We're both working, so we're making decent. I think I'm making 50,000. She's making 70, and we're parking I think 10% in deferred accounts, IRA 401ks. Again, I don't want to get too deep in that, but here's our tax bracket, and it breaks it down. So you see, we're paying 8.1 to FICA. We're paying 4.3 to the state, and we're paying 10.4% to the Fed. So that factor all that in, that's 22% of our incomes going to taxes. Here is when we retire. So retiring, and off the top of my head, I can't remember what it was, but I guess it's 69, 64. So I'm not sure. It's 67, something like that. So retiring. And so basically our the only thing we're paying here is the federal taxation right there, about 9.8%. Now, I did take a big lump sum distribution to pay off a mortgage. And again, this is just a scenario that I don't sweat it, because I'll dive into it, as I said. But anyways, that's what the significant jump was. But then, as you can see, no taxes, because all we're having here is Social Security. And again, we're using our standard deductions to maximize our IRA distributions to pay zero tax on. I'm not even doing a Roth conversion at this stage. I'll show you other episodes where we dive deep into that. So as you can see, while we're working, we got all those taxes. We're paying, 9.8% to the feds. We take a big lump sum distribution of an IRA to pay off our mortgage, our federal tax that jumps up again. And then once we're on Social Security, and we're maximizing our Social Security to cover our income, because our mortgage is paid off, we don't need a whole lot. We have no taxes. I mean, that's just a fact. And I'll show you a little bit more here in just a second. And then our RMDs start kicking a little bit. So we're still in the 2%, 2.3, 2.8, 3.1, 3.6, 3.94. Then all of a sudden, out of nowhere, kaboom. Look at that. It goes from 4% to the feds to all of a sudden over doubling to 9%. Then the following year is 11, 12, and then the following year it's 12.5% to the feds. Why do you think? So just look at that. What do you think caused that? You want to take a guess? 90 years old. All right. Charlotte's living until she's 94. I die at 90. So that's what it is. We go from a married filing jointly tax-paying unit to a single taxpayer unit. Now watch this. I think if I go here, bear with me just a second. I just off the top of my, yeah, okay. All right, so here's some of the strategies we can do when we do proposed Roth conversions and whatnot. It's just freaking awesome. This tax thing is fantastic. And they show you the conversion amount, income. It just, I'm not going to dive in that right now, but it's Write Capital just did great work here. All right, so watch this. So now I'm going to show you the tax form. So this is 2019. We're not going to show you that. I'm going to go to 2054 is when she dies. I'm going to go to 2050. Make sure we're still married filing jointly. Let's see here. Yeah, okay, so we're still married, filing jointly. Okay, so what you can see here is we have a little bit of taxable interest, Schedule B, a little bit of dividends, Schedule B as well. So we got $1,000 in interest and dividends. 13 is a little bit of capital gains, so not a big deal. IRA distributions, that's our mandatory distributions right there, $37,000. Here's our Social Security benefits. Right here is our Social Security benefits. Right here is our taxable amount. Again, because they're not indexed for inflation, look at that. We have $109,000 because we maximize Social Security. This is adjusted for inflation. I'll show you what I mean here in just a second there too. So we have RMDs, required distributions of $37,000. We have Social Security benefits of $109,000, which means we have $47,403 is taxable Social Security distributions. So we take our $37,000 RMDs, we take our $47,000 Social Security, and our adjusted gross income is $85,743. Scroll down here to our standard deductions. So remember, 26.6 is what it is today, but that is indexed for inflation. So in 2050, that'll be adjusted to 33,110. Subtract 85,000 from 33,110. Our taxable income is 52,000. Let's see, 42. We have some exemptions. Oh, that's right, because TCJA that's actually incorrect. The Tax Cut and Jobs Act, the Trump tax bill, is sunsets in 2026. So that's not under TCJA. That is not under TCJA. That's when you have your exemptions and your lower standard deductions. But fast forward, 32 years from now, standard deduction, what it used to be before last year, 2017, is goes to 33,110, and our exemptions goes to 17,845. So we have, again, gross income, 85,000. We take away our standard deduction, which gives us 52,633. We take away our exemptions. Our taxable income is 34,788. And then under the old tax law, 15%, we're going to pay, 10%, 15, or yeah, it was 10%, 15%. We're going to pay basically right about 10% tax bracket right there. In fact, adjusted for inflation, we're probably still in the 10% tax bracket. I guess we would still be. Anyway, it doesn't matter. You can see it right there. So basically 10% as our taxable income. All right, so that is in 2050. Let's go to 2051. And I think I have gone to my greater reward. Yeah, all right, so I've gone to my greater reward. So she still has some taxable interest. She still has some ordinary dividends. She get a little bit more capital gains now. She still has her same IRA distributions of 38,000, or mandatory distributions, because I leave my IRA to her. She still has required distributions. But look at this. Her Social Security drops from 109 to 63,000. That's not good. And yet her taxable Social Security is still significant relative to what it was when it was 109,000. Because she is no longer a married filing jointly tax-paying unit. This is what I'm talking about in this book. This is exactly right here, part and parcel, where the tax trap for widows is. So now she has taxable or adjusted gross income $81,683. We go down here. We take her one standard deduction, $17,000. Gives her $64,000 before we take her exemption, $9,000. So now she has taxable income of $5,500, which puts her in a tax at $7,200, which is twice what she's paying when I was still alive, even though her gross income is $81,000. Whereas before, let's not even think about gross income. It's actually her income. She only has 63. What do I do? Let me get my trusty calculator. She has 63,000 Social Security plus 38,000 of IRA distributions, plus about another 5,000 of various other income. So she has 106,000 is her gross income. 106,000. She pays $7,200 in tax. Yep. Now let's look at the year before. So remember, 106,000 and 72. The year before, when I was alive, we had 109 plus 37 plus another 1,000. So what's that? 147, basically 150. 150 of gross income, and we only pay 3,431 in tax. So let me show you what this looks like in the when we start looking at these numbers here. I think I got to go to distribution. Do I go to estimate? No, I go here. Okay, so we got to go back to here. So let me show you here we go. All right, so let me show you what I'm talking about here and how just dastardly this is. So now we're going to go to cash flows and retirement, and we're just going to go straight to taxes. Watch this. All right, so there's our federal taxes right here. Here's our state taxes. So and there's our FICA because we're working. So I'm alive. There's our state. I'm alive. Feds, we got the 0 years. We better start pulling money out of our IRA like crazy, which again I will do later right here. And we have very little taxes, nothing on the state. Kaboom, kaboom. Now look at this. That's when on my last year of being alive right here. $3,400 is what we talked about. And $3,400 in tax on $150,000 income. I die $7,200 of tax on $106,000 income. 10,000, 15, 7. It's insane. And that's what I'm talking about. So let's just show you what I'm talking about, a summary of cash flows. And here's our tax payment. So watch our income inflows. So here we are. My last year on this earth is we're making total inflows what you want. So total inflows right here of 2050, 146,000. All right. Where's our taxes? Tax payment right there. So 146,000 total income. Our tax payment $3,600. I die. Her total income 101,000. In this case, her tax payment is only $2,200 because you get that next year is fine. But look this. Following year 2052 total income 119,000. Her tax payment is quintupled, $15,000 from $3,000. $15,000 from $3,000. What happens is their tax payment is in 2052 for your distributions on your IRA in 2051. It's a little bit, actually, it's real world. That's really what happens. You take a big lump sum distribution in your IRA, you don't withhold taxes. You don't actually pay in this calendar year. You pay in the following calendar year. So that's exactly what's going on here. So essentially, the last year I was alive is we're paying taxes right here for what happened this year. So we pay $2,000. And then the following year when I'm dead, she pays $15,000. You see what I'm saying? So look at that. $119,000 income, and she pays $15,000 of taxes. When I was alive, $142,000 income, and we pay $3,600 in taxes. And again, just to visualize that, just to show you how the visual is. And this is, I'm just telling you, it's just brutal. And I wish more people saw. Look at that. Nothing. Boom. That's the widow's tax trap right there, part and parcel. Get the flipping book, please. $4.49 on Kindle, $5.99 on paperback. You can get it for free at heritagewealthplanning.com. It's the PDF version. You can get it for free. If this does not save you $5 in taxes, I'll be stunned, which means you're in a good place. But I'm telling you, look at that. That's bad. That is bad. Get the book, heritagewealthplanning.com. You'll see the pop-up. Just put your name, your email, and your state, and you'll get the PDF version. You can always get it for Kindle Unlimited for free. And we're going to dive into some more strategies on this in terms of doing Roth conversions and whatnot. But I wanted to share that with you because that bothers me, and it should bother you too. So that's some tax planning 101 for widows and how they just get destroyed when it comes to taxes. And that stinks. Because if we took advantage of this right here, which I'll show you what we do, we could have minimized this right here. And I'll show you that in a future episode. We'll see you next time. Don't forget to subscribe. Subscribe down below. As always, if you like what you see here, thumbs up. Always helpful. Comments. I'd love to hear your perspective. And we'll see you next time. Thanks, guys.